Welcome, and thanks for tuning into KBRA podcasts. We cover topical research discussions, industry commentary, and more. As we continue to expand globally, KBRA Podcast is a go-to source for timely briefings directly from our knowledgeable team members. In this episode, Marjan Riggi, Senior Managing Director, Head of Aviation, Transportation, and Commercial Finance at KBRA, speaks with Corinne Hill, Senior Director, and Michael Labuskes, Senior Director and Head of Shipping, about what a great year it was for container shipping. Other topics include potential opportunities, shipping financing, and ESG. The discussion will also include supply discipline. Does it last? Stay tuned to learn more.
So today we're going to talk about shipping in general and containers in particular. The reason we decided to this is because we just recently published a paper about container shipping. So we thought it was a good idea to do a brief podcast on it and just talk about it a little bit conversationally and hit the keynotes in that paper. So Mike, I'd like to start with you. Maybe you could give a brief summary of how the sector overall was affected by the pandemic in 2020.
Sure, thank you. 2020 was a roller coaster year in a lot of the different shipping subsector spaces. For tankers, it was fantastic in the early spring when oil prices were being dislocated. The futures markets went into contango, and anything that could float and hold oil was being sought after. The spot prices went crazy, and then shortly afterwards plummeted to make what was a pretty bad year for tankers. And that's actually expected to continue in through 2021. The containers were a very different story. It was lots of blank sailings when COVID first hit. Demand plummeted across the board, and the containers shipping was hit badly, but then it rebounded such that we're seeing record quarters towards the end of the year, and the space is expected to do well continuing into 2021.
So thanks, Mike. So Corinne, this is really interesting. Maybe you can give us some color on how the pandemic, first of all, has affected the container shipping in 2020 and also looking forward, and also whether there are other trade aspects of global trade that may have been somewhat significant in container shipping volumes to go up.
So in the beginning of the pandemic, the container industry was to be thought that declining demand would really impact the container ships negatively. But a funny thing happened. Consumers started nesting. They started buying goods instead of services. They actually saved money because they didn't spend on things like services like travel and restaurants, and they put this money to even more goods. And by the way, they also spent more online, which all turned into this e-commerce boom, which actually really helped the container companies as a result. Now let's turn to the two potential opportunities that we see as a result of the pandemic. Number one, passenger planes usually have about 50% of belly space for air cargo. And as we know, all those planes are grounded. The airline industry is predicting that that belly space won't come back until 2024. So we see this as an opportunity for those container ship companies to provide a lower price tag and gain a little bit of share from the airline industry. However, the airlines are not standing still. They are trying to turn some of their passenger planes into air cargo, 100% planes. So we will see. And the second opportunity is vaccines. We think that airlines is the likely transporter of the vaccines because they can go quickly and they can go globally. And so we think that there's a short-term opportunity here to take a little bit of market share away from the airlines for the container companies. Now, at some point, we think the consumers are going to go back to normal because, they're not going to spend on goods forever. At some point, they're going to go back to services. But we think the change will be gradual on the container ship companies as we move back to normal. Now let's turn to trade. By the way, we rely on the sovereign research team here at Kroll to provide a view on global trade. And then we in the shipping area try to analyze its impact on the shipping credits. They believe that there's going to be, or has been really, an improvement in trade, and this has benefited the container companies. This pandemic actually exaggerated the contraction and also exaggerated the rebound in global trade. A 4.5% drop in the third quarter actually was resulted because of this pent-up consumer demand that I talked about. That actually is much better than the awful 19% decline in global trade in the second quarter. The improvement is really due to China in part because they improved and became positive GDP in the second quarter and started exporting a great deal, especially to the US. This increased demand for goods, as I mentioned, led to this e-commerce boom that was a good year for container ship companies. And by the way, their credit metrics have been better as well. I would refer you to our report, What a Year for Container Ships, for the peer comparison of shipping companies. There's a chart there. And in sum, these two possible opportunities for container ship companies and the global trade rebound we think will help this container ship industry.
So that's interesting. I guess the goods still had to be shipped around the world. Even the services have come to much more of a stop, I would say. And I guess that's why container ships have been much more busy, right?
Yes, we believe that will continue, the goods buying.
So that's really interesting about the aspects of demand. Now, how about supply? What's going on in the supply part of a container ship? Are they balancing the supply with this higher demand? How are the ship owners dealing with that?
In terms of supply, we actually think that the supply for container ship companies will be low next year. The reason for it is, first, we believe that the container ship companies have discipline now. And this is due to the consolidation of many of the companies into 3 alliances. And they control about 81% of capacity. And during the pandemic, especially in the beginning, they acted quickly. They did blank sailings, which is canceled sailings, quickly. And they've also monitored the container trade issue and have been mindful about keeping the discipline. Number 2, we believe the low order book is very important to maintain discipline. It's the lowest in 30 years, the order book, and also only 10% of capacity. This is because we believe that container ships are not in a hurry to buy new ships due to lack of funding, IMO regulation, and also we really don't know what 2021 economy is going to be like. They're also afraid to buy because they don't want to buy a new ship that's obsolete right away because of some new emission regulation. Number 3, discipline has actually turned into a good thing in terms of managing the capacity with the higher demand. However, because of this spike in imports, there has been some port congestion. In fact, there's what I would call a perfect storm in Southern California. First of all, there's several days of delay there. The container capacity is almost full. And to make matters worse, there are COVID testing positive is hitting the labor in the ports. And also there's a lack of trained labor in the ports anyway. We also think there's warning signs throughout the world of other port congestion, including in New York, New Jersey. We also think the perfect storm will stay until the second quarter, and we're going to monitor the impact on container ship companies. So in sum, we believe that the discipline will continue, and also we will monitor that new issue supply very closely.
So you brought up the emissions. Mike, I just wanted to ask you, as you know, ESG is in the front mind of everyone almost globally in nearly every industry. And I think the transportation industry in general is at the forefront of it and shipping one of them. I was wondering whether you can give us some color as to how that the ASG regulation is playing out, how the issuers are dealing with it, how the ship owners are dealing with it, and how investors are viewing it.
You're right. It is definitely the topic of the day and becoming more so. In shipping it, the focus tends to be on the E part of ESG, with environmental, and particularly around the idea of decarbonization of the fleet. There's a lot of ways that this can go about, and there are targets from IMO for 2030 and for 2050. So there's a lot of uncertainty from the ship operators about how they want to do this. They can move their ships more slowly. That requires more ships. They can improve hull design and have new materials for paint that gets more fuel capacity. Some of these things take more time. They can look for alternative fuels. Again, this takes time, and there isn't the infrastructure globally to handle yet some of these alternative fuels. And the industry has to arrive at an agreement of what direction to go. So we're seeing some incrementalism, which can be great. It's moving towards liquefied natural gas as a fuel, dual fuel engines, as opposed to pure oil. The restrictions came in this previous year regarding sulfur emissions. So that's been some improvements. So it's definitely improvements are being made, but there's a lot of uncertainties, and that manifests itself in some ways around ship orders. What kind of ships are people ordering? When are they doing it? How long do they want to wait? And it also has finance implications. Most of the providers of finance, whether it be investors in the capital markets or banks, they've signed on to a group of concept called the Poseidon Principles, which aspire to control some of these environmental factors. And if you don't play by those rules, you're not going to get financing, or you're going to pay a lot more as you look for alternative sources.
Oh, okay, that's really interesting. Yeah, I guess this kind of relates to what Corinne was also saying in terms of part of the discipline is because of the unknown with respect to regulation and what kind of ship you need to buy. No?
Exactly.
So let's try to turn to the financing markets a little bit, which is what, as a rating agency, we're a lot more involved in. So I think that we've really rated many, many private transactions in this market in 2020, which I just was wondering, Mike, you could give a brief summary of why that would be and where we see that going forward.
Yeah, so a lot of the commercial banks, which have been historically provided the financing in this space, a lot of them some have exited, and a lot of the others have pulled back. That seems like it may have gone as far as it's going to go, but it creates a little bit of a vacuum. It might be a little too extreme, but I think it creates an opening for more capital markets involvement in this space. So we're seeing a lot more inquiries in not only just the traditional type of vessel financings that we've done, but also some more creativity in how to do more of them. And there's additional spaces are opening up as well, particularly with wind farms. We're seeing a lot of activity in that space. And as they build these farms out, they need vessels to service them. We expect more capital markets activity going forward.
I guess the wind farms also is part and parcel of a more green strategy globally going forward.
Yeah, fits right back in there with ESG.
Yeah. Okay, so we have also, just for the audience to know, we published a paper on container shipping, but we go into some detail in shipping markets in general. So it's on our website. You can access it for free. Just have to register. And thank you, Mike and Corinne, for this brief discussion on shipping. And I'm sure there's going to be another one soon.
Thanks, Marjan.
Thank you.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter @CrowBondRating. We'd also like to remind you that all of our ratings and research reports are free at KBRA.com. Lastly, please share your ideas for future podcast episodes or any feedback to media@KBRA.com. We hope to see you next time.